All right, lending ratios for difference between residential commercial. Now, it's up to 660 again as a range. Some banks will do 60, some will do right up to 80% on residential properties, and the normal maxed out figure is about $2 million. That's for residential properties. On commercial properties, you can borrow up to 70%. For non-specialised commercial properties where the trustee is an individual, they will wind that 70% back to 60%. Non-specialised rural property 60%, and 60% also applies for non-specialised rural properties where the trustee is an individual. Just let me talk about LVRs for a minute, and this applies whether you're in self-managed super fund or not. The thing that's killing deals at the moment, or not killing them, but the biggest challenge as a broker is valuations. The banks, there's always been an age-old theory out there that the banks sit the valuers down in a room before they get in their car and go out and check the property. They don't actually do that, but if a bank doesn't want to do a loan, they'll find a way out of not doing that loan. LVRs, in the residential area, the LVRs are fairly consistent. There's a huge surge to Queensland, and because of the mining boom, so I'm getting a lot of deals where people are buying properties up in the mining boom. And I've got a map of Australia that actually shows you all the mines around Australia. It's mind-boggling where all these mines are all over Australia. But some of the banks will not touch some of those areas in the northern, in Queensland. One of the banks, CBA for instance, have no postcode restrictions whatsoever. So banks have postcodes, category 1, category 2, category 3. Category 1 is your best postcode. It's residential, 30, 40 Ks from the CBD. Further you get out, category 2, Druin perhaps might be category 2. But CBA Bank don't have any restrictions whatsoever. So they'll end up on investment properties up to 95% in outback Western Australia, outback Queensland. The only problem you will have though, that's how much they'll lend, but on the valuation, if you're building and quite often this is what's happening in mining towns, people are building units in a mining town that's never had units before because the mining executives need somewhere to stay, and of course when the banks come to do valuation, they've got no comparative analysis to complete those units, and quite often those units will get slammed. In fact, the banks won't touch them. So if you are considering doing any borrowings or any investing in Queensland or even Western Australian mining towns, make sure you speak to a bank first before what their lending policy is for that particular postcode. You might find that it might kill the deal right up off the bat. Security provided by the borrower is limited to the underlying property being purchased, which I touched on, limited recourse borrowing, which is residential commercial. Supporting security in the form of a supported or unsupported guarantee is required from the members of the self-managed super fund, particularly where relying on the future superannuation. Again, that's a little bit of legal jargon there, and refer that to your solicitor. The trustee of the self-managed super fund and all associated sureties are to have a clear credit history and meet the applicable underwriting standards. I'm going over a bit more here. I think I've already touched on this. Property trustee must be a company. Company search is required for both the property trustee and the super trustee in terms of the credit checks. Banks will do credit checks. Banks do credit checks on every single loan. Doesn't matter how much, where, who you are. They'll be looking at your credit history straight away. In the bottom bit there, 6 months. For refinance, the customer must provide the following documentation. One of the huge differences between borrowing as an individual in investment property or borrowing within a self-managed super fund is the amount of paperwork. Normally in the applications, the actual commercial and residential applications aren't too bad, but the paperwork you've got to provide within your self-managed super fund, you've got to do 2 years tax financials. If you're self-employed, you've got to provide 2 years financials for your company. You've got to provide 2 years tax returns. There is quite a bit of information that the banks will ask for when buying under a self-managed super fund. And finally, just quickly, the 10 mistakes people make in setting up a self-managed super fund or actually buying property under a self-managed super fund. Treating SMSF, if they are a normal transaction, and that's, as I said right from the start, if you're going into it for the very first time and you've also had some experience in buying investment property outside, it's very different. You are governed by the SIS Act. You are required to set up a company as a trustee. You do have to carry out audits every year with your accountant, or it doesn't have to be your accountant. There are a lot of individual providers out there in the marketplace who all they do is go around auditing self-managed super funds. And I have names of those people if you need them. Not making use of expert advice. Pretty obvious, but I tend to put that up there because, again, I have people coming to me and entering this space for the very first time and they've not spoken to anyone. Critical that you do that. Not understanding lending requirements, buying property before the self-managed super fund is set up. Not setting up a self-managed super fund and a trust correctly. That does happen from time to time. Not adhering to the rules of self-managed super fund. So you need to understand the SIS Act, you need to understand what you can do inside that super fund and what you cannot do. Not taking demands on funds during retirement phase into account. Now that one actually is when someone comes to me, and particularly what age they are or where they are in their life span. People take out loans. So, you know, I get people who come to me in their late 50s and they want to take out a loan and they want it to be interest only for the first 5 years. So your first question is, what's your when do you expect to retire? And then they said, oh, well, in about 8 years' time. So it doesn't quite make sense to take out an interest-only loan for 5 years. I'm going to retire in 8 years, because the whole idea of borrowing property under a super fund is that you're building wealth up to move to that retirement phase, and you've got to pay the loan down. Again, it's not like an investment property outside the super fund. And therefore, if you're going to retire and you've still got a loan sitting there, your retirement income's going to actually be pressed to pay that loan. Again, that's where your financial planner, accountant, financial planner comes in. Not imposing rules on single acquirable assets. I could sit and talk for another half hour on that one in terms of what is considered a single acquirable asset. So each asset has a title. If you buy a property off the plan and you've got a garage downstairs and it has two separate titles, that will be looked at by the banks as two separate titles and will be an issue. If you buy a house and land package and there's a furniture package involved, which is happening again in Queensland in the mining towns, that furniture package is actually purchased under a separate title to the property. So you've got to be careful of those sort of things. Not adhering to differences to maintenance and improvements. This is a good one, because some people, you can renovate your kitchen, but you can't knock the 3-bedroom house down and build 3 apartments. That sounds pretty obvious, but there are people who think they get a bit confused with 8 and 9, the difference between maintenance and improvements, and changing an asset to a replacement asset. Again, very strict rules, not by the banks, but very strict rules by SIS. You cannot alter the nature of a property when you purchase it. All right, so as I just said, you can't buy a 3-bedroom house, knock it down and build 4 apartments under your self-managed super fund. You can't do it. The nature of the property, what it was when you bought it, has to pretty well stay that way. But they are very flexible in terms of what you can do to a property, providing you're not altering that property. One of the things I do, just quickly in closing, wanted to touch on, just going back to this single acquirable asset, you get this a little bit in the commercial space. Let's say I buy a factory and the factory has 5 sheds and each shed has a title each. So I'm actually buying 5 titles. So according to that, I can't do it. You actually can, because if you can prove to the SIS and the ATO that the 5 factories all contribute to the running of my business, then I am able to buy those 5 factories on 5 titles under my self-managed super fund. And you can challenge them on that case, and I've actually seen it happen. All right. I think that's just about it for me. That disclaimer basically says that everything I just said for the last half hour is totally incorrect. I'll be in the car and out of here straight after, so don't chase me. All right.